Hello, I'm Carly. I'm a director at BKL looking after academy audits.
Hello, I'm Lisa. I'm a senior manager at BKL looking after academy audits.
Today we'll be discussing getting your trial balance ready for audit. Lisa, can you start by giving us some key pointers in regards to getting the trust trial balance ready for the audit?
In terms of the timeline of the audit, because I think it's important to bring that in. So the timeline for an academy trust audit is incredibly tight. So the financial year end of an academy trust is the 31st of August each year, and the deadline to submit the academy trust audited accounts is the 31st of December. But of course, usually there's a half term in the middle of that first autumn term where people are away. And generally schools, break up not on the 31st of December, but a couple of weeks prior to that because people want to leave for Christmas holidays. So really you're looking at about September, October, November, and then half of December to get all the work done. But of course, we don't get the trial balance on the 1st of September because there are some adjustments that the trust will have to make and some finalising of their numbers before they give us the numbers to audit. Generally, what we look for a trust to do and prepare for the audit first is to review their numbers that they have on their financial system by the 31st of August. And they'll have a financial close process where they review their numbers and then look at any adjusting entries that they wish to post prior to the audit taking place. These adjusting entries will include various accruals for expenses where they haven't received bills yet for, but they anticipate they will be billed for them. And they also might want to adjust for any prepayments. So for example, expenditure they have actually physically paid out during the year. However, that expenditure actually relates to future periods, for example, IT licenses for the schools and educational subscriptions they may have. That sort of might span the next 3 years. They don't need to expense it all within that year. They might prepay, for example, 2 out of the 3 years that they've paid for. So those sort of year-end adjustments we would ask the trust to make prior to the audit starting, so that we are, as an audit team, in a good starting place to test their numbers. And we don't necessarily have a sort of draft trial balance from them and then wait another 2 weeks and then receive an updated trial balance. It affects our audit work, so our audit testing obviously is much more efficient if we can start sampling things on that first week that we're due to test everything. And then of course we also, for most of our trusts, we also help prepare the accounts as well. So if we get a final trial balance from the client, we then send that on to our accounts prep team for them to prepare the accounts in our accounting software. So the two sort of match up together. So if we get delays in that, it makes the whole process a little bit inefficient. And of course it's stressful anyway with the tight deadline.
There's also the point about depreciation, which comes in the same sort of subject as accruals and prepayments at the year end. And of course we'd like trusts to post their own depreciation adjustments throughout the year, not just at the year end. But if they're not posting them on a monthly basis, then I think you'd agree that at the year end we need them posted as well before we get a trial balance for audit.
Yes, so what we see with a lot of trusts absolutely is that not just the depreciation but capital additions, so items that should be capitalised on their fixed asset registers that shouldn't be just expensed, should be adjusted for and put on their fixed asset register and capitalised when the asset comes into use by the trust. So for example, obviously a new building is quite obvious to be capitalised, but smaller items that aren't expenditure in nature but are capital in nature should be capitalised on the register when they come in use. From the date that that asset is capitalised, there should be depreciation charged on the asset in line with the trust's depreciation policy, which should be documented in their financial procedures manual. So we don't just want to see capital items being left in, for example, a building maintenance and repairs trial balance code at the year end for then us to move up to fixed asset additions and then for us to depreciate those items. It should be the trust to ensure that they identify any items that they deem as capital in nature, for them to sort of be a bit more proactive with the process. And then it allows us to simply audit the figures that they deem as capital in nature and audit the depreciation calculations that the trust has done, not for us to sort of do it for them, because that also sort of can imply almost a management threat or a self-review threat that we have done the work and then we're reviewing the work ourselves. So it's much better if the trust does it first and then we review it second as part of our audit procedures.
I think just a sub-point on that is also SIF income. SIF income shouldn't be deferred, of course, or capital income in general, but SIF income in particular shouldn't be deferred. It should be recognised in full in the year that the trust received beneficial entitlement, the capital funding, and that should feature as part of the trust's year-end procedures in looking at what adjustments they're making at the year end. Are they deferring something they shouldn't be deferring? Look at the capital projects that they've been awarded or capital funding they've been awarded throughout the year, and have they actually recognised or accrued for that income at the year end?
Yeah, there is a lot of confusion around capital income and whether you should match the income with the expenditure that's been incurred so far, or whether you should defer any capital income you've received if you haven't spent it yet, or whether you should accrue for the whole lot of the capital grant. And generally the rule of thumb is for the SIF grant, so conditional improvement fund monies, when you have that, as you said, that entitlement, that unconditional entitlement from the ESFA, the Education and Skills Funding Agency, that the trust are entitled to that full amount of money. The rule of thumb is you should recognise that income in full because you are due that money, regardless of whether you've received it in full yet or whether the trust has started works on the project yet. So on the expenditure side, however much money they've spent on the project yet, it doesn't really matter on the income side, as long as you've accrued the grant in full. That is generally the right way of recognising it. There are of course other capital grants like free school grants, and generally with those, just to add a little bit more detail, you would accrue monies in income that you are due to receive based on the receipts that you submit in terms of the expenditure that the trust has incurred. So you sort of, in that respect, you do match your income that you're due with the expenditure that you've incurred. Whereas with SIF money, because you get this big SIF funding letter up front from the ESFA based on the costings that you've submitted via, for example, a tender, you would recognise that grant in full.
Thank you. I think that's wrapped up all the points that we wanted to discuss on this particular topic. Thank you very much for listening to our conversation about preparing your trust for audit. We, of course, offer a free helpline service for all of our clients, which directly connects you to the relevant team for any ad hoc queries you may have throughout the year. But we also offer various other services, including due diligence work, internal scrutiny work, Annex G returns, AAR work, BFRO work, and much more. So please do get in touch if you're interested.